In 2025, the investing world is more volatile than ever. Markets are swinging wildly. New technologies emerge and disrupt old industries. Headlines scream about inflation, interest rates, and looming recessions. In this chaotic environment, many investors are making the same critical mistakes, and they are paying the price. Meanwhile, the rich, those who truly understand the game, continue to grow their wealth steadily, year after year. Why do most investors fail? And how do the wealthy consistently succeed? In this video, we'll explore the psychology behind investing failure, and the mindset and strategies the rich use to win the long game. The psychology of investing. Why emotions destroy wealth at its core. Investing is as much about psychology as it is about numbers. The markets may be rational over the long term, but investors are not. Fear and greed dominate human decision-making. And these emotions lead to devastating mistakes. Panic selling during downturns, FOMO buying at market peaks, chasing hot trends without understanding fundamentals, ignoring long-term strategies in pursuit of quick gains. These behaviors destroy wealth faster than any market crash. Why most investors panic when markets fall? Most investors panic because they lack a long-term perspective. They see temporary declines as permanent losses. They forget that markets move in cycles. And they ignore the fact that history shows us, every major crash has eventually been followed by a recovery and new highs. Without a strong investing mindset, fear takes over. Investors sell at the worst possible time, locking in losses that could have been avoided with patience. Why FOMO leads to bad decisions. Greed is the other great destroyer of wealth. When markets are soaring and headlines are full of success stories, many investors abandon discipline. They chase hype. They pile into speculative assets. They invest money they can't afford to lose. And when the inevitable correction comes, they are caught off guard, with overextended portfolios and no plan to manage risk. Short-term thinking versus long-term wealth. The biggest difference between average investors and the wealthy is time horizon. Most investors think short-term. What will happen this quarter? What stock will double this year? How can I beat the market this month? The rich think long-term. How will this portfolio grow over the next decade? How do I preserve capital through multiple market cycles? What assets will still be valuable 10, 20, 30 years from now? This shift in perspective changes everything. How the rich stay calm during market crashes. When markets crash, the rich do not panic. Why? Because they understand market history, have diversified portfolios, maintain sufficient liquidity, focus on quality assets with long-term value, and are not over-leveraged or overexposed. For them, market crashes are buying opportunities, not reasons to sell. They know that downturns are temporary. And they are prepared to take advantage when fear drives prices below intrinsic value. The importance of liquidity and patience. Patience is a superpower in investing. The rich maintain liquidity, not to chase hype, but to be ready when true opportunities appear. They are willing to sit on cash or short-term instruments while waiting for attractive entry points. They do not feel the need to be constantly, fully invested, because they understand that sometimes the best action is inaction. When great assets go on sale, they deploy capital strategically, without fear or hesitation. The power of compounding. One of the greatest tools in wealth building is compounding. But compounding requires time, and most investors interrupt it with poor decisions. The wealthy understand. Frequent trading kills returns. Market timing is nearly impossible. Long-term holding of quality assets allows compounding to work its magic. They build positions patiently. They hold through volatility. They let dividends reinvest and gains accumulate over decades. This is how fortunes are built, slowly, steadily, inevitably. Diversification. A shield against the unexpected. Another key strategy of the rich is true diversification. Not just 60/40 stock-bond splits, but diversification across geographies, currencies, asset classes, equities, fixed income, real assets, private equity, alternatives, and time horizons. This protects against shocks to any single market or sector. It provides stability in volatile times. And it ensures that opportunities in one area can offset challenges in another. How the wealthy manage risk. Risk management is not about avoiding risk. It's about understanding and controlling it. The rich size positions appropriately, avoid excessive leverage, hedge strategically when needed, maintain liquidity buffers, and regularly review and rebalance portfolios. They are not trying to beat the market every month. They are trying to survive and thrive over decades. The role of professional guidance. Many wealthy investors also work with trusted advisors. Not to get stock tips, but to maintain discipline, avoid emotional decision-making, structure portfolios tax efficiently, and plan across generations. The right guidance can prevent costly mistakes and help investors stay the course through challenging periods. Why most investors fail. Summary. In summary, most investors fail because they let fear and greed drive decisions, chase short-term gains, panic during downturns, ignore diversification, interrupt compounding, lack a long-term plan, and fail to manage risk effectively. How the rich win the long game. In contrast, the rich think in decades, not months, stay disciplined through cycles, maintain diversification and liquidity, harness the power of compounding, focus on quality assets, manage risk proactively, and seek professional guidance when needed. This is why they succeed, not by chasing the hottest stock, but by playing the long game with patience and strategy. How you can apply these lessons. You don't need millions to follow these principles. You can start today. Shift your mindset to long-term thinking, build a diversified portfolio, stay patient through market volatility, focus on quality, not hype, keep costs and taxes low, let compounding work over time, develop an investing plan, and stick to it. Wealth is built not through brilliance or luck, but through consistency and discipline. Final thoughts. Most investors fail because they approach investing emotionally, reactively, and without a clear strategy. But you can choose a different path. By thinking long-term, staying disciplined, and focusing on sound principles, you can build wealth that endures, even in the most volatile markets. If you found this video helpful, please like, subscribe to the channel, and share it with others who want to become smarter investors. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or consult with a qualified professional before making investment decisions.